Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, June 8th, 2023. It's 8:05 a.m. Eastern Time, so I'm starting this video in the pre-market session. I usually wait till the trading day is underway, but because I was out a good part of last week, I told you another mini vacation down in the Keys. Got back late Sunday night or Sunday evening, and just been trying to get individual charts out to you lately and focus on just a few things right now. But what I'm going to do in this video, so I can walk you through it, I'm going to start out with the equity markets as I usually do. I'm going to go not too detailed, but I'd like to touch on all the different indexes because that's really the common theme right now. There's tremendous and really, I think, never before seen divergence between the NASDAQ 100 and the stock market. So we'll talk on that a little bit. I'm sure most of you are aware of that. I've talked about it quite a bit over the last couple weeks or a month or so here. But so I'm going to go over that, go over the markets. I'll touch on the VIX. Somebody asked for an update on the VIX. I gave a chart, which I'll go over in this video. And time permitting, depending on how far, I'm going to watch the clock. If I can get in this video, I'll hit on gold, silver, platinum. I shared that as those are trade ideas recently, the euro, US dollar. And then energy too. I want to just briefly talk on crude oil, natural gas, and the coal stocks. They're actually looking a little bit interesting right now. And so let me dive in here. Start with QQQ. QQQ, as we all know, has just kind of hit this turbocharge here. Myself, and I know I'm not alone in this camp, how you want to define it's up to you, but I think there's at the bare minimum overhype with AI. I called it last week a mini bubble. Call it what you want, and if you consider it's certainly debatable whether it's going to change the world and change the stock market. But again, I look at many factors. I look under the hood. I'm not a one index person, a one QQQ or SPY. I look at market breadth, and that's probably the biggest red flag in this market now. And there's very much bubble-like traits, similar to the .com with Nvidia, and then anything that's got its little stamp, AI stamp on it, and that includes Microsoft, of course, and Alphabet, and those. So anyway, let me get to the charts. And again, that's what we're talking about here. And zoom down. This is a QQQ, still clinging by the skin of its teeth, almost ever so slightly higher high, but for all intents and purposes, equal highs on the RSI, slightly lower high on the PPO, with much higher highs in price. That is negative divergence all day long, and it's still there, and it's there in all the indexes. So why I know some of you don't want to hear this, my technical view, when this starts to change, that's when things change for me and we start to get out of there. The one thing that did change, we took out the top of my max bounce target zone. And you can call this what you want. You can call it confirmation bias or ignoring something. And that's where I figured things would start to change. And that's what I said before. But what's happened here with the NASDAQ compared to every other index, I don't know if it would qualify as a Six Sigma event, but I can tell you statistically speaking, it is actually, it's from what I can gather and what I've read, never ever before seen where we've had such stark outperformance by the NASDAQ 100, or really just that handful of stocks that overweight the NASDAQ 100. I updated all the holdings recently, I'll get to, but I didn't update this total here. But it's still a handful of stocks make up over half the returns. I've said this once, I've said 1,000 times. It shouldn't even be, it technically is an index, but it's the most unbalanced, overweighted index. It's not representative of anything but 6 or 7 companies. That's all the NASDAQ 100 is good for. Now, it's a trading vehicle. You can trade it. Those companies tend to have a very high correlation, and so it's unusual to see 4 or 5 of those going up strong and then 2 going down. It can happen. We saw Meta kind of tank before, but again, so this is, and again, you can call it what you want, but this is, I would take this breakout with a ginormous grain of salt, and I'll show you on the chart. So there's the NASDAQ 100. Just a quick tidbit. I'm going to kind of go as I do. Sometimes fire off on tangents. Somebody asked the other day about My views on the still, am I looking at what was before 20, at least 20 to 30%. I was honing in on that 30% number drop. It's even higher now because, since I went on vacation, really was, the Keys last week, and then Maui right before, Kauai before that. And then we went up a little bit from there. Not a whole lot. The momentum is certainly stalling out and has shifted in the near term. That's why we're short. This is that 15-minute chart. And where I'm going is somebody asks about, hey, is that still your view? And will you let us know when you think that started? Well, here's the thing. You don't want to hear this, but you only know in hindsight for sure. But I feel that if I'm going to be right on that call, and there's going to be another 30% plus, downside. I think right now I'm looking more about 35 from the recent highs. That if that call is correct, then this is probably the top right there. All right. So I'm not in the business of calling tops and bottoms. You can do that if you want. But I would say with a pretty high degree of confidence. And the reason is if we go up a lot higher, we're starting to take out key levels. The S&P, everyone's been harping on the big support it just took out, but it's just barely above. That could prove to be a false breakout. But where I'm going is, and I'll show you here in a second, if we go much higher, even in QQQ, again, I'm watching the whole market. I put a much higher weighting on all the indexes, the stock market. If we start seeing breadth improve, and like I said before I went away, if you want to play anything, start playing the small caps, and things that have lagged behind. You have more upside, better risk reward, and that's what's been taken off lately. The small caps have been moving up, but I'm going to show you again. So here's that quick trade update. There it is, S1 taken out. That opens the door to move down to T1. T1, as I mentioned yesterday, we consolidated on. This is how it works. This is why I list multiple targets. Each level is where you're likely to get a reaction. I told you my views on this one. The reaction would probably be minor and fleeting. I didn't expect a big one. This is a little bit better support. If and when we get there, we'll probably have a tradable bounce, a reaction that I define a reaction as one of two things. When I write that word, when you're looking at the post on the homepage, you'll see little squiggly lines. I define a lot of terms that I throw out here. And if you hover over that, I don't have the site loaded right now, it'll give you my definition of a reaction. I define it as one of two ways. When you're going down and you hit a level, a reaction is either a bounce or a consolidation on that. In other words, you stop. It's like throwing tennis ball against a brick wall, that's going to bounce, or you throw a sandbag or a hacky sack against a brick wall, that's just going to stop for a while, right? And that's the difference there. So it could be either or. And so I try to share my thoughts, which ones of these are gameable or likely to produce a bigger reaction. And we'll only really know for sure when we get there, depending on how the charts look. But as I told you, a few days ago, with this trade, I expected once we took that out, you start hitting some stops. And at some point, this thing will start to accelerate. So where I'm going, back to where it was a minute ago, on that question, the 30%, very, very much this trade may be extended. This may be the top. So this may morph, because I had some comments. Yeah, it's right now, and I threw it out there as a short-term pullback trade, overbought, negative divergence, my kind of setup. So far it's working out. And should my third target be hit, which is the current final target for what I called a short-term swing trade, that's a little better than a 5%. You can see the pop-up box to the left, 5% drop, a 5.23. And, so far we nailed the high. We shorted before we even broke down. I had that much confidence that we would break down, but I said, take a starter, and then there's your sell signal when you got the breakdown, and then, you can add to that and trade it as you want. So that's that. And so if and when we get to T3, I'll share my thoughts, but I'm going to tell you now, in case I don't update it, depending on how things look, if you are of the mindset I am, and I know that's becoming fewer and fewer. I see some are outright snarky comments on the site. I don't care. I have thick skin. Say what you want. I told you many, many, many times before. I had high convictions that we were going to drop. Start going down before objective short levels. I don't care. I said only guarantee I ever give is that I'll be wrong. I'll be wrong a lot, and nobody bats 1,000. So throughout this bull market, batting well over 500. And I'm happy with that. And again, take the trades that align with what you believe And never at any point was this QQQ an all-in moment. This was, we were still waiting for sell signals before. If you were adding, scaling in short back here, anywhere in here, there were still sell signals, and primarily that trading range we needed to break down. That was on the 60-minute right here to start to where that was where I said if and when this breakout failed. And I still maintain that's pretty much an all-in moment. I'm talking about this sideways trading range here. I'm using a sloppy drawing tool, but I think you know where we're at. So, and this is a 60-minute chart I just jumped out to. Remember, we were on a 15. That's what this trade was based off. But this coincides with that 5%, that T3 on the 15-minute chart, and that's where you're likely to get a nice tradable bounce. Nothing's guaranteed, so if you do recover your short and reverse long for a bounce there, don't get married to it, because at some point, let me say this, I'm throwing all these out, this is why I do these videos, there's a lot in my head. This is one of the most, I want to call it an extremely crowded trade. I suspect that the move in QQQ and all these tech or AI related stocks, this may be one of the biggest short clearing moves in recent history. I suspect numbers they lag. You can only get them. They come out, publish short interest data twice a month, and even then, by the time they come out with it and publish it, it's almost 2 weeks old. I think it's like 12 days after the actual date that the numbers were taken. So you just kind of have to know that I think it's safe to say a lot of shorts were blown out there. And what that does is it creates a kind of more of a vacuum underneath the stock. So where I'm going with that, what I'm trying to say is just keep in mind things could fall fast if we start taking out support levels. So if we blast through, and that's the nature of a bear market, you can blast through support levels like they're not even there. Sometimes act as just a little speed bump. So there's that uptrend line. That's the same level on the 60 we're talking about. If and when that goes, that's going to be significant. That'll be a sell signal. And then I'll continue to communicate where we're at. So I just wanted to reiterate, as of now, still looking good. Let me just flip over to when you might, if this was an open session with questions and answers, which would take forever, but you'd probably say, well, what makes you think, how can you say this is still a bear market? Many of the long-term metrics, my longest term, my monthly indicators, trend indicators, they're still by the skin of their teeth, but they're still clinging to bear market sell signals, showing us that this is at this point in time. And again, it is subjective. One could argue either way based on the indicators you're looking at. The ones I'm looking at, a decent case can still be made that this is nothing more than a bear market rally. But once again, we go up much higher from here, especially if you start to see the S&P 500 participate, the mid caps, small caps, and QQQ can power on higher. Then you start to take out some levels that make it very hard to argue that you are still in a primary downtrend, that this is just a counter trend, i.e. bear market rally. Okay, and this is one of them. Fibonacci retracements are very simple, highly effective. I've covered these many times in the past. What you're looking at here, I know it's hard to see. I cannot make these numbers bigger. I'll just read them out to you. This is the 61.8. So this is the entire bear market. The NASDAQ peaked back in November of 2021. So far, the bottom was in October of 2022. And so if you measure, that's what this blue line does down. These are the Fibonacci retracements, a typical counter trend bounce, whether you're trading this daily time frame, 60-minute, depending on the size of the trend you're looking at. This is the daily or the primary trend right now, and you can see we're at the 61.8, which is, it's not a set in stone number, but it is. These are, from my experience, where counter trend rallies will typically retrace from the previous move. And again, that's the entire move down so far. They'll typically retrace anywhere from 38.2, 50, or the 61.8. So we're right there right now. We're literally a hair below it after a brief and ever so slight overshoot. But that's, for all intents and purposes, let's just say we're right there. Divergences are still in place. Okay, remember, QQQ is an outlier. That's me. I'm like I said, I'm factoring in these extremely unusual circumstances. Again, from what I've read and heard, since the either the data was being tracked or the Nasdaq. The Nasdaq is not as old as the S&P 500, and the S&P 500 is much more the market. And so you want to really look at the overall stock market. Here's QQQE. I'll just put this on here because this is my fib board. I have this on the other board, but you can see very clear negative divergences, and these are where the big trends come from, the big trend changes. So and if I've heard it once on the site, I heard it 1,000 times. I've said this 10,000 times. The divergences are not sell signals. They are merely indications that a trend reversal is likely. It tells you that the momentum is waning. You had positive or bullish divergences at the lows when the market bottomed, big divergences, and then from all the way here down to here, and now you have negative divergences, and there's a nice little wedge. This wedge would take us down quite a bit, and in my opinion, be the catalyst to most likely take us down and to and below the previous lows. Okay, but what I'm showing you here is if you strip out the tremendous overweighting of those handful of big tech, almost all associated with AI, and that's Microsoft, Apple, Amazon, NVIDIA, especially NVIDIA, which is now, just briefly hit the $1 trillion club and now was one of the largest holdings of the NASDAQ 100, Meta, then this is where we've gone so far. We've only retraced 50%, a run-of-the-mill retracement. So I'm trying to say this because I know some of you are relatively new to this and you're thinking, oh, the strength of the NASDAQ is just that's bull market stuff, Randy. No, I've said it 100 times and I've traded through bear markets. I love bear market rallies. Admittedly, I got out of this one, closed my longs too early, started shorting too early in the NASDAQ, and that's fine. Again, bat 1,000. But the reason I love them was, clearly bullish and long at the lows in the beginning of the year. Literally on the second trading day of the month, stated closing out my last of my shorts going long, and that was on the QQQ. And I also made mention that the QQQ is where I was overrated, that the FANGs, Apple, Alphabet, Tesla were the strongest looking stocks. And again, they ran up, they exceeded my upside expectations. So, caught the first half of the move and then fought the second half of the move. And again, it was very unusual to see that carry forward. But when you look at the what I just did, here's QQQ 618, QQQE equal weighting, only right at the 50% fib. This is the 50 right here, this line. Make a straight line, bring it across. Keep grabbing the wrong drawing tool. I got to get rid of that squiggly line. Here's a flat horizontal line. That's the 50% retracement. So there's QQQE. Real quick, let's do SPY. SPY is at the 618 to the button. And again, SPY, if anything, is more of the stock market. And, taking out that big overweighting. Negative divergence, very clear. So, and I've been pointing out these divergences. And again, they've only gotten larger, which to me indicates that two things. Number one, there's still likely another leg down coming, and the further you go up and the more bubble-like characteristics, if you look into valuations, everything's extreme, especially on those big tech stocks. It just sets the way for an even bigger drop. So time will prove me right or wrong, and keep in mind there's other things. Everyone seems to hyper focus on the market calls. You should, I don't know, I can't tell you what to do, but you never only trade one, if NDX, QQQ, or even SPY, that's one trade, one security, even though it's diversified, SPY much more so than QQQ. But, there's a lot of other things out there, bonds, corporates, treasuries, commodities, which are, 3 dozen at least that I cover regularly, gold, silver, different sectors. So that's the key, is spread your eggs out. Don't put all, if you had everything in QQQ or the semis, yeah, you're feeling a lot of pain. But if you had it spread out, gold, we're long gold, most of the ride up, got out of hair early, but then got the top, nailed the top, caught that pullback recently, got out of the miners. So if nothing else, there's value there. And if you're diversified, then you're not feeling that much pain if you had been short the Nasdaq like I had recently. So just wanted to cover it out again and say right to the button, the S&P 500 at the 61.8 fib. If you look at the equal weighted S&P 500, which again, the S&P, it's not as bad as the NASDAQ 100, but it still does have the highest overweighting because it's a cap weighted index on the big market leading tech stocks. And the equal weighted has only retraced 50% to the button. So I'm doing this video today live, and almost every index I just covered is within basis points of a key Fibonacci retracement level. And so maybe I'm beating a dead horse here, but again, nothing's changed. And the only thing really that's been going up, when you look at the S&P or the equal weighted or the Wilshire 5000, if you want to use a really good index that's probably the best index or the most accurate for the entire stock market, would be this one. And it's right where right at the 50% fib retracement. I know I have a lot of lines here, I have fib clusters, but here's the high, there's the low, measured by the white line, which is right here, to the button, only a mere 50% Fibonacci retracement. So that's it. Don't want to beat a dead horse, but that's what I was saying here. We were at the 50% fib, we went back. So the stock market's gone nowhere. Again, let me reiterate, the stock market, which is, if you count everything, all the stocks out there, and you look at the small caps, it's gone pretty much nowhere. The only thing that's gone anywhere is the NASDAQ 100. And even within there, 90% of the stocks are down and lagging. It's only a handful that have carried this market. Again, I know I'm not the only one pointing that out, if you're following. So this is IWM, the small caps. Here's their bear market. They haven't even retraced, even though they popped lately. Like I said, if the market holds up, you're going to see value, people running at what's been lagging. And it's had a little lift lately, but it's not even to the 30. Well, actually, let me clarify that, because we hit the bottom here and it did retrace. It went between, since it bottom, it had really a double bottom right there. And it did run up at this point to the 50% or just under the 50% fib. And there split the difference, split the crosshairs between the 38 and the 50. But it's been making lower lows. This is the nature of a downtrend, is lower highs and lower lows. Now it needs to take out to say that the bear market is still ongoing. Once, if and when that previous double bottom is taken out, then it will be very clear. Because again, you want to sit there and say, well, near term we're making some higher highs. Well, you had 1, 2, and then we're still below that. So here's what happens. The NASDAQ takes out this high. Yeah, you've got a case to be made. There's a near-term uptrend. Still work to be done. You can run all the way up that 61.8 and still be a typical counter-trend bounce. So, all right, enough on the indexes, I think. Let me make sure I covered everything I wanted to there. Yeah, all right, so you get my point. And again, there's momentum in the small caps now, and that's mainly because of those regional bank stocks. I mentioned a couple weeks back that, if anything, that looked, best. You had the big on KRE, the big positive divergence in just about all the bank stocks. And, take it, said you could sell at 42. It was resistance, or this was right before I left for the keys, or set a stop and let it run. And if you did that, just keep trailing your stop up and see how far this will carry. But I believe this rally is going to get sold into sooner or later. There's so much that I don't talk about. I do once in a while, but the fundamental, the macro, couldn't be any more bearish. It's almost an anomaly right now how I guess this market's just still awash with liquidity. But again, it's an illusion with money only chasing a handful of stocks that are so big by market cap that they distort what's really happening under the hood. And again, I just showed you. Look at the equal weighted indexes. Look at the S&P 500. Look at the Wilshire 5000. And remember, the reason I focus on KRE because they have a big weighting in the Russell 2000 small cap index. So you're going to see the Russell go up and down with these regionals. Okay, a quick update on the VIX. Told you I'd cover that one. All right, so what I see on the VIX, what stands out to me, you have this previous major reaction low back there in about July of 2021. Remember, the NASDAQ 100 peaked here in November, right there. S&P peaked right in the beginning of January. So the VIX was already starting to rise. But this is a major reaction low. And if I take that line across, we're right there. So, any security, when you have a major, reaction low, distinct low like that, that is a support level. People are going to focus on that. And the VIX tends to come down to these levels. And you have, just like you have on every index, every major index on the daily chart, the S&P 500, they all have that negative divergence that I showed you earlier. Well, you have positive divergence on the VIX, and that's usually the case there. So remember, the VIX goes up when the stock market goes down for the most part. And so there's your positive divergence right there, very much at support. There's your divergence line right there. I don't have a good downtrend line to draw because it's been this little straight, which kind of meshes with that final pop, which appears very much like a blow off top in the NASDAQ 100. That you get a blow off top when you've had an extended uptrend that's already getting kind of long in the tooth, and then at that point you just have a near parabolic move up, thrust up. That is very indicative of a blow off top. And so in reverse, of course, you have the VIX kind of plunging like that. So we'll see. Time will tell. Basically, there it is on the 60-minute chart. There's your positive divergence. And again, there's not a great uptrend line. I just know that this will, if that QQQ trade starts to get some traction, we get down to T3. Oh, that's another thing. And my response, if QQQ hits that current final target at T3 on the 15-minute chart, that will probably coincide with a move up here to about that. See, that's pretty good resistance. You had several reaction lows, about 1573, and I think I measured it. Yes, I think that's an 11% move. So it'd be about a 5% drop in QQQ, be about 11% move there. And then, of course, if that happens, what it does, it starts to change the charts. It starts to confirm. You get the bullish PPO crossover. And it can start to firm this divergence up and set the case or set the stage for a much larger move, just like it would help to confirm the negative divergences on the indexes. All right. All right, let's do gold and silver. We're going to start out here with the euro. Euro put in this divergent low back here, back in late September of 2022, rallied up. Put in a divergent high, had a nice correction, and a bigger divergent high. So the pattern is, and as you know, a few weeks back, after being bullish and long gold, it started to get bearish because you had this bearish rising wedge. There is an unmistakable correlation. I've covered it many times. To keep this video from going an hour or more, I'm not going to do it right now. You can do it yourself. Overlay either the euro directly or use the euro US dollar pair, which I'm using here, and overlay the price of gold and go back years. And there's times, brief times, where there's a disconnect, but other than that, they have a very, very strong and unmistakable positive correlation. That's because the gold and the dollar have a negative correlation. And why am I talking about the euro? Well, the euro is pretty much the opposite of the dollar. The US dollar index, it's the largest by far. There's not even a close second. The yen's the second largest holding, but it's dwarfs like half of the weighting the euro is, and then everything else doesn't even move the needle. So the euro is pretty much inverse the dollar. It's 57.6 weighting in the dollar index. So if you want to know where the dollar is going, you just have to know where the euro is going, and vice versa. So and so that was it. So there was a beautiful bearish rising wedge, well defined. What I've done here with this purple line, you probably can't see it in the video, that's the measured target. And it happens to, I haven't touched these levels. I've had this 104,738 level here, created that line back in July of 2022, right? Haven't touched it since. And that's where that would project. So I want to say this, recently posted silver as my favorite, and it has outperformed gold as a long, trade for a quick counter trend bounce. Remember, after being short. And that could be it. And we fell down to that support level here, and that may be all the move. You don't have to hit the measured target. And when I'm talking about the measured target of a rising wedge, you take the widest part. So right here, down to the bottom of the wedge, and that's what I did. And I put that line there. So we could see another thrust down in the euro, which would be another leg up in the dollar, and that's going to put pressure on gold. So right now, again, I'm cautiously bullish and long the metals, and you can, of course, the miners are going to move with it. If to be long gold, bullish gold or silver is typically, unless there's a meltdown in the market, is to be long and bullish GDX. The way it works is silver and GDX, they follow gold. They're just more, it's more of a leverage play, if you will. They just tend to have a higher beta. They move up more. And that's usually why, of the two metals, unless I see a reason not to, I'm going to be long silver when I'm bullish gold. And I'm also going to be long the miners, because if gold goes up 10%, the miners usually go up 20. It's not a set 2-to-1 ratio, but it's, and likewise on the downside, they tend to fall a lot harder. So that's it. Anywho, but on the 60-minute chart, and this is part of the reason for going long lately, we had a nice breakout. This is a 60-minute chart of the euro US dollar pair. You had nice positive divergence, downtrend line. That's a breakout, successful back test, and so now we need to take out this level. If we do, that's going to lead to another leg up in gold and silver. Otherwise, if we crap out, then we're probably going to go down to that next level there. So, just don't let the silver trade get away from you. That's the one I'm preferring right now. I threw it out here. When was it? The other day. We're up, nothing big, but it's up about 5-6% in the last few days since back here. What is that, a week or so? That was the low was on the 26th, Friday. And we've been zigzagging higher. So just like the euro, you need to take out this recent high right here. You got, see these couple 1, 2, 3 reaction highs. When you pop that, 22.55 is the next stop. Probably get a reaction there. It's pretty good resistance. And of course, the way it works, if you take that resistance and you go up to the next level. So there's your targets. There's the positive divergence, the reason we went long that recently. There was a negative divergence. We were able to sidestep or short and profit that 13% drop right there in silver. GDX, same thing. It's just going to mirror gold and silver. And let's see, there's my lines. So hopefully some of you either profited or at least sidestepped on your longs. That 17% drop right there. And just like gold and silver, you put in the divergent low recently. A little bit. We're very oversold on the RSI, but yeah, positive divergence on the PPO right there. And kind of walking our way up. So again, cautiously bullish is what I would like to say on the metals. I think I've covered that enough. GLD, there it is, divergent low, 60 minutes, see my positive divergences, support. And if we go down here, we could extend the divergences, and whether you get stopped out or you want to ride out and maybe add to it here, that's the next support level. And you would still, if you get down there as of now, if it happens soon, you'd still have the positive divergence. Gold really needs to take out that downtrend line right there, and then it can has the potential to run. Bigger picture is huge. I mean, this is a long term. I just jumped to a weekly chart. That was the last bull market in gold, ended back in 2011 right there. We went to a bear market that ended in December or late 2015. It's been in a bull market since, and that is a massive level. So you have that previous bull market high, and then you also have 1, 2, 3, pretty much a triple top here. You do have negative divergence. So you remember a few weeks back, I'd been pounding the table, long-term, clearly long-term bullish and long most of the time gold. I'm a swing trader, so when I see these divergences, we get out, and game the pullbacks. But I do have to, and as I pointed out, recognize you've got big negative divergence. Now, if it's a bull market, there's, a case can be made fundamental, and we pop that, we may burn through those divergences, and that would be very bullish. So, but as of now, you just have to recognize this and respect that if we have a failure here with this triple top and these divergences play out, gold could go down. And the way you look at a triple top pattern, by the way, guys, is usually if you can find a well-defined support, some boxing in that triple top. The way a triple top works is if you do fail and you break down, this would be your breakdown point, about 157. If you get rejected, the measured target is the distance of that box or that range. There's your support. So that line right there, here's how I do it on the charting platform. You take a line, draw the line right there, and then take that line or duplicate it, one of the two. I just take it and drag it. And that would send gold. And look how it lines up perfectly with that key 130 target. That was, to me, a massive breakout. If you followed me back then, it's talking about 130, 130, 130, and we popped it. And that was, like, to me, just one of the best buy signals I've seen in a while, and it gave us the strongest leg so far in the bull market. So that would also send gold back down there. So just food for thought, but you know, it's not written in stone, just something to watch for. So right now, as I usually do, I give you my long-term view, but the short-term charts are going to dictate my positioning. I'm not going to, you know, short gold now for that, or go long in anticipation of breakout. Those 60 minutes are a much better guide to keeping you on, you know, the right side of the trade there. Okay, the other day when I threw out silver, I threw out platinum. That was here. You had a breakout. There was your breakout right here. Went up, hit my first target, pulled back as usual, ran up a little shy of the second target, but you can see here I have divergence line. We put in some negative divergence right there, and that's, you know, was the technical catalyst for the pullback, but we're coming up to trend line support. So if you took profits at T1 or you didn't take it, whatever, I can say it's objective to go long here at trend line support for the next leg up to T2 and ultimately T3, with stops somewhat below that trend line if you want to keep them tight, and that's PL. So again, watch PL can quite often, platinum and palladium can do their own thing. PPLT, by the way, is the ETF if you want to trade that instead of the futures. And they kind of march to their own drum beat at times. Silver follows gold very closely. Platinum and palladium, again, kind of do their own thing. Okay, I'm tracking okay on time. I'm just going to cover and tell you that I haven't been covering crude lately because crude has just been doing this thing. It's been chopping around aimlessly in a not even so well-defined trading range. Now, you get a well-defined trading range. For a while, that was it. It's easy. The MO is sell the top, buy the bottom of the range, back forth. Short, cover short, go long. But now it's, had that spike down. It's just sloppy trading. And so therefore, I haven't done many updates on crude oil. That's the thing. There are a gazillion securities out there. If I sat there in every video, every week, covered every security, the site would be useless. You couldn't keep up, you wouldn't get through the videos. There's no point. So if there's something I forget about and I haven't covered, ask, by all means. Let's throw it out in the comment section. Hey, Randy, can I get an update on gold? Can I get an update on crude oil? But I just wanted to say, bigger picture, this thing's been range bound in a sloppy range. I see no trade. You get chopped to pieces trying to trade this. If you've been trading crude oil successfully lately, kudos to you. More power to you. Share it on the board. Share it in the comment section what your trading strategy is. There it is on a 60-minute chart. However, I still look, one of the most promising energy commodities to me right now is natural gas. I've been talking about this for a while. Yes, divergent low, just like the divergent highs in the stock market. Have they played out? No. But have they gotten bigger? Yes. Big divergence right here. We had a divergent low there. Got it there. It keeps making these marginal new lows while these divergences get bigger and bigger and bigger. One point, I don't know when that'll be, probably sooner than later, there'll be a turn and natural gas will decide that it wants to, go in an uptrend. And when natural gas, does kind of once in a blue moon, it'll chop around once in a while, but it's usually either full throttle up or full throttle down. That's just the nature of this beast. This has been more of a, you can see the rate of descent. That was a very strong sell-off. And now the momentum, the downside momentum is waning. And that's what these guys are. They're called momentum indicators, the PPO, the RSI. It shows you the downside momentum is waning, and that's what gives you the positive divergence, with prices making lower lows, but yet the indicators making higher highs. It's that simple. So is there a trade now? Yeah, we have positive divergence on the 60-minute chart. Let me get to NG, natural gas futures. This is it. So you had divergent low there. I believe it was pointed out. I know that one was. And you had a trade. And it's not like these trades, that was a, from high to low, that was a 21% pop. This one was 32% pop. And that was pointed out recently when we recovered that. So there, has natural gas bottomed? No, you can't say that yet. Only time will tell when you can look back and it's much, much higher. But even these little micro rips are very tradable. Get in, look for these divergent low, and look for the divergent highs to get out. That was a rally into resistance right there. Gosh, I keep grabbing that wrong line. Here's my horizontal line. So that was, it is still 2.869 on the, what are we looking at here? The Julys. There was a nice price channel right there. And more importantly, that positive divergence I like to see. And again, positive divergence, rally. Oh, I just told you 30 something percent, 20 something percent. And so boom, breakout, it's moving up. And look, it's back above this level here. It recently put in pretty much a double bottom. And this is a potential bottoming play, just like where I started the video with QQQ, that I'm only showing you a near-term setup on QQQ now. But it, again, very, very, very much has the potential, if you shorted the Qs the other day when I did and when I put it out there, that could be, you may have shorted the high. We were within basis points of the high so far. Only time will tell. But like I said, I can continue to communicate QQQ as I will with UNG or natural gas, as whether whether it should be, you get a little divergence. Yeah, you're already getting a little negative divergence, but we just broke out of a much bigger, we're just coming off a much bigger divergent low right there. So that typically will supersede smaller divergences. Small divergences usually give you the pullbacks after a breakout. Anyway, so I like that one. And then last but not least, the coal stocks. Shame on me, because when I got back on Sunday night and I was looking Monday, these stood out. I was going to mention it, but I was going through the charts trying to find, as many good setups. But, I just want to point this out now. I'm not crazy about them. And coal is a dirty word. It's a dirty, burning fossil fuel. Of course, we all know that. And, we got Biden declaring a war on, fossil fuels. But yet, how much of that's been priced in? That was support. I'm just adding levels. So this one just broke out. It's coming off that divergent low. That's NC. I'm just going to rifle through my list here. METC, positive divergence right there. Target would be that downtrend line in the 200-day moving averages, these red and blue lines right here. So I don't know how much more meat left on the bone, but about 14% or so. There's one with a trend line right here, Arch Resource that pops that trend line. I haven't marked up all the charts. We were very oversold, extremely oversold recently at support right there. So, that would have been a nice, I'm sorry if it's hindsight, but I wouldn't cover this if I didn't think there was still a potential play here. So I'm just going to tell you right there is a little minor resistance. If it can pop this level, it takes out the trend line and that 116 level, and that one could run up. Minimum and first target I would give you would be right here, about 136, 60-ish. That'd be about 18%. So I'm sharing these as potential trade ideas. AMR, now that one, obviously, if it breaks that's pretty big support right there, about 137.70. Not my favorite, by the way. I like the other ones I just showed you, but that's one of the, I'm just going through my coal stocks one by one here on a watch list that I have, and just showing you that this one, you can see there's resistance about 1680 or so right here. Boom, if it can pop that this thing could run. Don't fall in love with these. If they reverse, they can fall hard. And beta adjust. Coal stocks they move high. They go up and down very high in percentage terms. So when I say beta adjust, what I mean is if you normally trade of SPY, your number, let's say, is 10,000 in a position, then you might want to take half of that in these coal stocks, because when they run, they're going to run a lot more. Likewise, when they fall, they're going to fall harder. And by adjusting it down to a $5,000 position instead of your usual 10, you can allow a much wider stop, and that'll help you stay in the trade. But if your profit targets hit, you're going to make outsized gains in percentage terms. That's what that is. So look at that breakout, divergence right there, positive divergence. I didn't mark them all up. You get the picture. So anyway, that's something that there's a sector as a whole. BTU, HCC, CEIX, yeah, some of them are kind of meh, but the ones that I showed you that earlier I liked. There's one that just put in a big divergent low as well. AREC is a ticker on this one here. Big positive divergence coming off the low, testing that 200-day moving average right now, and really price resistance. It needs to pop this level. See, 1, 2 reaction highs, 188. And I'm going to lower, I would say, target about 226. And it might be, not seem like a lot, but that's 21% if hit. So, all right. That's Chinese coal. All right, I'm done. All right, so that's it. I'm gonna wrap it up here. Oh, I'll give you that update on that BYND. I'm trying to find some individual stocks. I told you I wasn't crazy about it because it was low volume breakout, but it is a breakout and it's still holding it. So, like I said the other day, what I did. I took a starter position. I want to see some a reason to add to it. Yesterday didn't show me that, but it did backtest. Today's the second day of backtesting the trend line. The white just shows you what's going on in pre-market. So the way this one works, if it falls back through a solid close back below there, stop out, get rid of it. That's a false breakout. That's bad. It can go down like that if that happens. What you want to see now is moving up, and ideally you want to see on increasing volume, and now you want to see yesterday's high get taken out as well. So a big green candle on above average volume, that will help. And every charting platform is different, but I don't think there's one out there that will not give you. They all have average volume, and so you want to look at, like, you can see on the upper left hand corner, a pop-up box, 90-day average volume is 2.5 million. So there's a formula you can use during the day. There's 6.5 hours in a trading day. So if you look at the volume, let's say at 10:30, that's the first hour into the day. Take that number and multiply it by 6.5, and that's going to give you, after the first hour, what it's tracking at. That can change. Hopefully that makes sense to you. But that's how you can tell early on. Hey, at 10:30 or 11 o'clock, 12 o'clock. Hey, am I tracking at or above the average volume? And you can look also at the volume bars. That's one simple way. Here you can see my volume bars down here. I think you can in the video. See, that's a big volume. That's a big down volume day. That also is indicative of a selling climax. That's the thing. When you see a stock that's in a confirmed downtrend, it's like that buying climax I talked about on QQQ, but in reverse. So when you see a stock falling, and this one went down from $22 all the way down here, it got chopped in half, and then all of a sudden there's just one big red candle on very high volume. You saw increasing volume here, higher, huge volume. That is very indicative of what we call a selling climax. That's when the last of the weak-handed longs couldn't take the pain anymore. They puked it out. Maybe some Johnny-come-lately shorts came in there, shorted it, and now the stock has not gone below that level, and it's starting to hold. So you have this little trading range. If it can pop here, we already took the trend line, but if it can pop these recent highs right there in that box, that one should run. And again, I already made my comments. Somebody said, the fundamentals are, of course the fundamentals are horrible. We're in the NASDAQ's been ripping. I believe this is a NASDAQ stock, and it's not in the NASDAQ 100, not at that price, but NASDAQ. And yeah, the dang thing's down. It's in a bear market, 95%. I'm not looking to get married. I don't want to marry this stock. I want to date this stock. This is a Tinder stock, not a Match.com. You get in, get out. The shorts get squeezed. The profit potential's big, as is the downside risk, but there it is. You hit that first target there, you're talking 45% gain. If it happens to take out the trend line, it has a lot more potential. But first things first. So let's see how we do here in the next couple of days. Let's see if the starts taking volumes and starts moving up. But the chart's huge. The chart projects that this stock could hit any or all of these targets. You could have doubt if the market's going to take another 20-30% plus leg down. Unlikely, but possible. If this one's not indexed heavily, it can march to its own drumbeat. Apple is not going to go up 20% if my call on the NASDAQ 100 dropping 35+% to the downside happens because of indexing. It's going to have a tremendous headwinds. But a stock like this, again, if it's not heavily indexed, I don't know if it is or isn't, guys. I'm looking. This is based on the technicals, not fundamentals, so you can do your own due diligence there. Okie dokie, I'm going to wrap up now and start hunting for some more trade ideas for you. This has been Randy Finney with Right Side of the Chart. Have a great day.